Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's going to be generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in. Let's see what people are sharing, and I'll interject my opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, deeper into the companies that I'm playing for the commodity bull market, and share more freely all my opinions on those companies. We still have a discount coupon code, MAYDAY, MAYDAY, if you are interested in joining to get a 50% discount on the first month of membership, just only the first month, or a larger discount on a yearly membership if you want to move to a yearly membership. So we've got a quote here by Peter Lynch. He says, "Don't buy cheap stocks just because they're cheap. Buy them because the fundamentals are improving." That's exactly what we are doing in our investment strategy. We are buying cheap stocks where the fundamentals, the metrics that we look at are free cash flow growth, earnings per share, margins. All of those things are growing. They are using their free cash flow to buy back shares, increase dividend payments. Basically, we've hit the inflection point of the fundamentals, and those fundamentals are changing in a positive direction, which take time. It's not immediate, it's not overnight, and it takes a little bit of time. And the ones that inflect and change the most are the ones that have the highest stock price appreciation. And we have plenty of examples in energy service companies that have inflected pretty rapidly, also in oil exploration and production. From the bottom of 2020, where the large inflection point of oil going negative to $120, I think is where it peaked out at in 2021, we saw a massive inflection of the fundamentals improve for those companies. And some of the companies have gone anywhere from 5, 6, 700% all the way up to 30 times returns, 35 times returns since 2020. That's how big they can move. Um, and we've been in a consolidation. I'll show you what that looks like down a few slides. So URA, the ETF for uranium, I've overlaid the last commodity bull market for a natural gas company over URA, the ETF. The herd is behaving similarly so far. I don't think there's really anything to worry about, at least not yet. The blue, I call that fractal. It's a repeated pattern that goes over time. We're seeing this pattern play out over and over and over again in the market for a variety of different commodity companies. We've seen it in energy service companies. The service companies are kind of located down here. They're kind of working and squeezing into the corner. Some of the exploration production companies are in that same location. This pullback that we've got here is an inverted head and shoulders pattern for the energy companies. Shipping is basically already broken out, much like URA is broken out here. And everything's tracking along pretty well to this fractal. And I would say that the fractal is probably pretty close to where we're going to peak to late 2020s, early 2030. That's where I would put it, where this could peak out. So everything it's kind of following what it should. And I know some people are perhaps not happy that some of these stocks aren't going and moving the way that they think they should move. But stocks don't move straight up. You get pullbacks. Sometimes the pullbacks are 30, 40% in size, depending on the stocks that you're in and the sectors that you're in. But things don't go straight up. So patience is what pays. Patience is what pays, and buying the undervalued companies where the stocks are inflecting into positive fundamentals. Exactly what Peter Lynch has said. Completely. So here's silver long term. I got a couple of quotes with it. So silver's cup and handle pattern. I love this pattern. It is very plain as day to me, the way that it looks. I threw a line going across, hitting these closing points kind of. I didn't push it too high. It's got the cup and the handle. We've broken the handle to the upside, and a lot of the times you get a return move back to support. That return moves 28, 28.50, somewhere in that range. The projected move, if this is a valid cup and handle pattern, which it is, in my opinion, I put it on top of this cup here, $350-ish, $300. It's probably a projected move for where silver might go sometime this decade. Now, I know people think, oh, it's broken out of the pattern, it's just going to go straight there. That's not how it works. A pattern this big, it's going to take time to play out. And I think it might take 10 years to play out. It might only take 2 years. I don't know. I don't think anyone else knows the exact time, the time frame, and the exact path. A lot of people try to predict this stuff and they get it wrong. But I look at this big picture view. I'm in it. I'm in it massively. I'm playing the silver bull market. We've a long way to go to the upside for this pattern to move, and we could have very good returns. Now, does that mean that I put everything in silver? No, that's not exactly what I would do. So I just take a big picture view. I look at the big picture here and say, you know what? This is a possible opportunity with a huge asymmetry, which is a lot of upside, limited downside, and I'm going to play this. And what I do is I try to find setups similar to silver, like this. And if there's 3, 4, 5 different setups, maybe the pattern isn't as clean as silver, but maybe a ratio is very low, like platinum. And then I buy all these different assets and I just hold on for a decade in them. I don't need to win on every single asset. The symmetry is going to carry my portfolio higher if I win on just a few of the assets. If I win on every single one, then that's just going to mean it's going to be all the better, make all that much more. So it's more of a strategy of acquiring cheap assets at a good time that are positively inflecting. The fundamentals are positively inflecting. I can show you some of the fundamentals for silver in a couple of later charts. And that is exactly how I'm playing all this stuff. And then I look at the companies, and some of the companies are absolutely good in terms of entry points. They're very low. They've got tons of upside potential. And the symmetry is what's going to carry me. So I don't have to be right on everything. If I'm right on just 60 or 70%, it means that I'll probably tenfold the portfolio. And that's the symmetry carrying me, because some of these are going to go up 20, 30 times, which are going to make up for ones that maybe are delayed or are not going up as much. So it's that symmetry. Oh, and the quotes. Let's go over the quotes. It says, after spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It never was my thinking that made the big money for me. It was always my sitting, says Jesse Livermore, who is supposedly one of the best traders. Here's another one from Charlie Munger. He says, the big money is not in the buying and the selling, but in the waiting. And that's where the big money is made. I am adopting everything I can from what I've learned and all of the best investors in the world on how I can adopt some of their strategies and viewpoints and psychological tricks that they've got up their sleeves to make as much money as possible and make the most of a lot of these bull markets that I think are coming right ahead of us in commodities and precious metals. Now here's oil. I'm a huge oil bull, absolute massive oil bull. It says long-term reminder for oil chart, in my opinion. So we've got these consolidations. It breaks the consolidation and has a big run. This run was in the 70s. We had another three hump consolidation. It broke. It started in 98, 99 and broke out in 99. It did a retest and then ran. We've done another three hump consolidation, which ended in 2020. We broke in 2021 the downtrend line. We are consolidating on top of that trend line, ready to break to the upside for a third wave. There is generally a 5-wave move. There's an up wave of 1, a down wave of 2, up wave of 3, down wave of 4, and an up wave of 5. And I think that its potential, the possibility here, is oil going somewhere between $350 to $700 a barrel. I know that sounds crazy, but people are going to say, well, how are people going to afford that? Well, they would have said the same thing when it hit this up here at $150, coming from the bottom of only $10 a barrel. So it went from 10 to 150. We're going to do something very similar to that. Maybe we go from 20 all the way up to 15 times 20. So maybe $300-ish, $350, something like that is very possible. And it's the dollar that's getting hit. It's the inflation that is driving it. Every single one of these periods occurred under an expansion phase of real estate, and we are in an expansion phase of real estate. So my question to everyone who's not an oil bull over the next 2020s or so, I'm not talking short term, I'm talking about the 2020s. What makes you think that this is not going to occur? Put it in the comment section. Love to hear your guys' opinion on it. I'm in this because the pattern is suggesting that we're going higher. We are in an expansion phase of real estate. We've got fiscal spending, which is another driver of inflation. The credit expansion, which is monetary inflation, occurs under bank lending. So fiscal and monetary, those are the two drivers, and they are both hot at the moment. We're in the cycle. They've raised rates to slow the monetary lending, but the fiscal spending is still high. And everything from this chart that I can tell is a-okay to move on higher for a big bull market in oil. Let me know what is going to not, what could stop this oil bull market. And what I mean by stop it, I'm not talking about delaying it. I'm talking about stopping it completely. In history, I have not seen anything that has stopped this. Extra supply, it doesn't come on fast enough. It's not going to be a recession because that would only delay it. It wouldn't stop the move. So I don't know what's going to stop the move. And I'd love to hear what you guys think would stop the move completely. This is Terry Smith. In 2022, Terry Smith gave a brilliant interview with the Economic Times. Smith promoted buying good companies, don't overpay, and do nothing. And that's exactly what we're doing. Our strategy is to buy good, I call them good high cost companies because that's what gets you the leverage. It gets you the symmetry. You don't want to overpay for it. And we're buying these things when they're ultra cheap, when the ratios are cheap, and then you do nothing for a long period of time. It's exactly what Warren Buffett does, exactly what Charlie Munger does. It's exactly what Jesse Livermore suggests. It's the big money's in the waiting. It's exactly what this guy is also suggesting. Coming down to Bidbird. He says, when are we buying lithium stocks? I think we're still early, but there might be an opportunity at some point. Keep in mind, though, that lithium, although it's great and it's used in batteries, it could be substituted out. And we'll see if that occurs and we'll see if it doesn't. But I think it's a little bit while longer. I think we're going to have to base a little bit more before lithium really takes off. I haven't seen any strength in the renewable area yet. So that's lithium, rare earth metals. Some of the base metals are kind of struggling in the short term. So it makes me think that we still have a little bit more time to consolidate maybe lower or sideways before we start liftoff in lithium. It says, you are right, oil will be more important than many expect, and you are wrong in oil dominating. Uranium is ready to dethrone oil and will continue to increase importance over the next century. I'm going to disagree with that pretty hard. Oil is the number one commodity. Uranium is much more siloed into electrical generation. And although uranium is going to play a huge part in the future, which I do not doubt that, Oil is just in a completely different game. So uranium is like, I mean, if uranium is playing soccer, oil's playing baseball. They don't even play the same games. Oil's in basically everything. It's in paints, it's in lubricants, it is in a bunch of things like plastics, and it's all over the place, guys. We bathe in oil basically. Everything we do, everything we buy, everything we see, it's like oils in all of these products. Uranium is not. So to say this, I don't know if you understand the reach of oil products in the world. It's basically in everything. Your house is surrounded in oil. Your car is made out of oil. It runs on oil. It's lubricated by oil. I mean, everything. It is everything. So an electric vehicle is bathed in oil. The batteries are made of oil in terms of the casings, the paints. I mean, all of that stuff. And uranium doesn't touch hardly anything in relationship to how much how many things oil is in. So I don't think it will dethrone it. I'm sorry. I don't think that will be the case. U.S. monthly crude production in the blue versus the oil-directed rigs in the white. It's doing a lot more with less, but I don't know if that's necessarily the case. What he's saying is that since this is going up and the rig count's been going down recently, that we're going to do more with less. There's also drilled uncompleted wells. There's a bunch of things behind the scenes that are also being depleted in inventory wise. So we build up a bunch of inventory. We're now depleting the inventory of those drilled uncompleted wells. They're called Dukes. It doesn't mean just because the direct rig count today will impact the oil production immediately. You kind of have to work through inventory of a lot of that stuff, and then eventually the rig count will definitely matter because you don't have the Dukes inventory. Being a successful contrarian investor means betting on theses that at some point become consensus and getting rid of them before the market realizes everything has already been priced in. And that's what I have in the strategy. It's the three pillars. And it's identifying what is cheap, identifying when that becomes expensive through the ratios, using technical analysis to validate that the herd is in fact placing money where you think it's going to go. It's an unbiased way to do that. And then market cycles is another thing that can overlay with ratios and technical analysis to understand where you're at in the cycle. So that if you know where you're at in the cycle, you've got a cheap ratio and the technicals look good. That's called confluence, is what I call it. And that's when everything aligns for good things to happen for an investor. You're increasing the odds of success as an investor. So stocks and bonds says you've never lost money in stocks over any 20-year period, but you have wiped out half of your portfolio in bonds after inflation. So which asset or which is the riskier asset? Well, bonds is. Bonds is the riskiest asset because you're losing money in purchasing power. Cuppy says, been a tough year, my own damn fault for having so much energy, but keep trying to grind out the gains here. So he's he's up 17% for the full year, looks like, working his way on up. And I am also very heavy in energy. So if he's heavy energy, he's up 3% in May, 4% in April. His full year is 17%. That's pretty good. And I think that mimics what I've done up to May. June's been kind of a rough month. We've had some pretty big selling pressure going on in energy in June. TrendSpider says 2024 looking a lot different than previous election years. Will we see a return to the mean? 2024 has been absolutely ripping versus some of these other election years. It's been just ripping it. Oil stocks and oil will dominate all other stocks for the next 10 years. Mark my words, it won't be AI. Completely and utterly agree. Why do I agree with that? It all comes down to the valuations and the underinvestment in oil and how oil is so critical to the economy and how inflation sensitive oil is, and where I think fiscal spending and potentially monetary um, areas will increase the credit supply. So I think it will impact oil directly. And the underinvestment in oil is going to absolutely come out like we've never seen before. And that's also what the charts, technical charts that I showed you earlier, are suggesting. So I completely agree with him, not because I want to, it's because the charts agree with him. And the commodity to stock, the commodity to stock ratio is cheap for commodities. Like everything's in alignment for this to occur. Now, will it occur immediately? That I don't know. Will it occur in 6 months, 1 year, 2 years? Definitely the next 10 years, it will occur. But I can't tell you if it's a couple months from now, or if it's 6 months, or 1 year, or 2 years. Oliver says silver market balance, massive deficits over many years. And this is the supply demand balance that we look at. So supply demand for silver, demand is the blue, supply is the yellow. When you start to run deficits like we did in 21, 22, 23, and potentially here in 24, and as large as those deficits are, we're going to eat through inventory. When you eat through inventory, you're going to get to critical levels and the price goes way up. And if we continue to run deficits, the price will continue to go higher until we balance out the demand and supply. At what price will it be balanced? I don't know. I don't think it's going to be anywhere close to where we're at today. So if you can't invest $1,000 well, you won't be able to invest $100,000 well. More capital won't make you a better investor. It will just make your mistakes more expensive. And I don't really change my approach no matter what the valuation, what amount of money you put into it. A lot of people just naturally migrate to less risky stuff the more that they accumulate, but that's up to them. But the investing strategies are all the same no matter how much money you have. Chris says, what would my 45-year-old self tell my 25-year-old self with regards to the market? He says, buy and hold index funds and add to them every year. Buy and hold a basket of the world's leading companies. Add on 20% plus on dips. Stop active trading. Do that, and the results will be in the top 5%. Less is more over the long term. And I would agree for the most part with this. I do think a lot of guys look backwards and then try to linearly apply what they've learned forwards. That may not work over the next 10 years. I think commodities are going to do absolutely ridiculous things towards the end of 2020, and it could start at any time here. And that's where huge returns are going to occur. You don't want to buy and you don't want to do active trading, in my opinion. I agree with that. And I own a basket of the world's cheapest assets in the world, mostly commodity and precious metals focused. And that's where I'm going to focus my efforts because that's where the most runway of valuation and symmetry that I can find in the companies and in the commodities themselves. That's what I can find in the market. The worst part of the bull market is the rise of inexperienced people educating other inexperienced people. The worst part of bear markets is the doom and gloomers finally feel vindicated, even though they've been wrong 90% of the time. Now, I want to make a comment here, and I'm not a doom and gloomer. I'm definitely an optimistic. I will continue to look at things from a bullish perspective because it pays to be a bull. Most of the time, things go up, they don't go down. And you don't need to win all the time. All you need is a couple of really big wins, and that will carry the portfolio into a level where you don't have to work anymore. You just need a couple of big wins. You don't need to win on everything in the portfolio. You don't need to win on every single position. But if you win on just a few with some money in it, the returns from the symmetry will be so big that it will carry the entire portfolio to levels that a lot of people don't think are possible. Here's Gergen. He says total U.S. rigs are down -4, oil's down -4, gas unchanged, and miscellaneous unchanged. The total rigs were down 97 year over year. So oil rigs hit the lowest level since January of 7th, 2022. Just let that sink in. And you can see the rig count kind of coming down in a three hump consolidation. We're going to bottom here at some point. I don't know when that point necessarily is, and we are going to run higher. This is the U.S. Baker natural gas rig count. We were up at a 1606 back in 2007-8, and we've come all the way down, and this definitely looks like a bottom to me. Totally looks like a bottom. And then weekly crude oil production per rig has been going up. So that's one thing that is definitely good for the exploration production companies, is that they are getting more oil out of these rigs. They are doing different drilling techniques that are more productive at getting oil. There's absolutely no signs of stress in the financial system. Why cut rates and risk higher inflation? Yet the 10-year yield is plummeting. None of this makes any sense. He's looking at the St. Louis Fed Financial Stress Index, really, really low. And he's coming to the conclusion that there's no financial stress. We also saw, I think it was yesterday I shared it, that there's this reverse repo that's got hundreds of millions of dollars, millions or billions, I have to look at it again, probably hundreds of billions of dollars, that is getting loaned out, like bailouts going on. So there is some weird stuff that is going on in the markets. This is the U.S. oil rigs fall 4 to 488, a new cycle low. So we did drop a little bit of rig count, and that has impacted some of the energy service companies, unfortunately, if you are following energy service. This is XH or XPT. This is the platinum in price in US dollars. It says the trend line is clear as day. Platinum is charging up to join the big move, just like gold and silver. And we've got a potential break here at some point in platinum. We're just underneath that downtrend line, putting in higher lows coming into that trend line. And it might take a little bit of while to break it, but it looks pretty solid this time. But that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We do have a question and answer session coming up today, 5 p.m. Mountain Standard Time, if you'd like to join. And I'll be on there, and I'll be answering all your guys' questions. So that's all I've got for today, guys. We'll catch you next time. This is Finding Value.